Good day, everyone. For this session, we are going to move to another topic, which is IAS or PAS 1, presentation of financial statements. So you can see here on the screen the elements of financial statements from assets down to expenses, which are already discussed exhaustively in Overview of Accounting and the Conceptual Framework of Accounting. So allow me to discuss this particular IAS 1. And here are our objectives. So we should be able to enumerate and describe the general features of financial statement presentation. So what are these features? And then let's describe each. Enumerate and describe also the components of a complete set of financial statements. So what composes the set that we can say as complete? Then we have to state the acceptable methods of presenting items of income and expenses, differentiate between the statement of profit or loss and other comprehensive income, as well as the statement of changes in equity. Then state the relationship of the notes with the other components of a complete set of financial statements. By the latter objectives, you can see already the other financial statements that would comprise the complete set. We have actually the statement of profit or loss and other comprehensive income. That's one. Statement of changes in equity. That's another one. And also the notes to financial statements. So to continue, the objective of PAS 1 is basically to prescribe the basis for presentation of general purpose financial statements. As what we've said, that the financial statements under the standards actually would result to financial statements that would cater the needs of wide array or range of users or decision makers. These financial statements can only answer the common needs among these particular groups of users or types or kinds of users, or let's say classifications, but not to their specific needs. As said, only the common or general needs. To improve comparability so that we can compare one entity over another entity or entities in the same industry, or we can compare an entity's financial statements of the prior or previous periods. So if we do the latter one that I mentioned, which is comparing the financial statements of an entity for the previous or prior periods, you call that intracomparability. It is said as intra from the word or the term like internal, right? So intra is like within. So that would be within the company. It's the financial statements of the company or same company. But if we compare the financial statements of one entity over another entities in the same industry to which it belongs to, it's called intercomparability because it is within one entity over another entity. All right. So that's how we achieve comparability both intra and inter. Next, so general purpose financial statements would serve the common needs of wide range of external users. Yes, true that there's an emphasis of external users who are outside the company who cannot demand reports specifically tailored for them, unlike with management that is an internal user. So they cannot have the authority to demand financial reports tailored for their own needs. So general purpose financial statements are the subject matter of the conceptual framework and the PFRSS. So even our Philippine Financial Reporting Standards, even if they're specific PFRSS only, or then, but they can only answer the general purpose reports. Okay, so here are the 6 financial statements that comprise the complete set. The 6th one actually is not that mentioned, but then, of course, to comprise the complete set, there are 6 of them. Statement of financial position, which is known formerly as the balance sheet. Statement of profit or loss and other comprehensive income. So there are 2 components, profit or loss, which is formerly known as income statement, and the OCI or other comprehensive income. as a whole, you can call this one a statement of comprehensive income. The third one is statement of changes in equity. And then this equity would depend upon the type or the form of business or the legal form of a business organization, whether that is a sole proprietorship, a partnership, a corporation, or a cooperative. Then the fourth one is statement of cash flows. Fifth would be the notes to financial statements, comparative information in respect of the preceding period. So we can see notes, additional information, and the additional statement of financial position only when certain instances would occur. All right, so these financial statements as enumerated would be discussed one by one later on. So anyway, before I continue, allow me to just give the highlight or breakdown. Statement of financial position would show to us assets, liabilities, and equity. Then the two would show now the income statement items. We have revenues or income and expenses and the OCI. Then changes in equity would be the components of the equity or capital. This would be shown here. Cash flows could be inflows or outflows. So the plus and minuses. Okay, so general features. Here are our general features. So one of which is the fair presentation and compliance with PFRS. So to achieve fair presentation, it must be that we should comply all provisions applicable to PFRS's, the Philippine Financial Reporting Standards, and we also have to include even the disclosures necessary to have fair presentation or to achieve it. So we cannot achieve then fair presentation or compliance by just complying the majority. It should be all standards that are applicable. We cannot also say that all standards there will be complied because some standards can only be applicable to certain situations. You will know that as you go along the way with the standards. Number two, going concern. So in going concern, also known as the continuity assumption. In fact, this is like a review of our overview of accounting. This simply means that an entity will continue for a foreseeable future time, indefinite period of time, or beyond the horizon. So this simply means that the entity will, of course, think that it will continue operating despite the fact that the business will have to end somewhere. But the question is not actually clear as to when the business will end. So an entity is not then a going concern if there's an intention to liquidate. When you say liquidate, you are going to stop or terminate the operations of the business, sell the assets, and pay the liabilities, and other ways or arrangements to properly end the business, or to cease trading, to stop doing the business, or there has no realistic alternative but to do so, meaning no other option but to stop the business. The assessment of going concern is done at least 12 months from the end of the reporting period. So if the ending is, for example, 2019, December 31, that's a calendar year. So a calendar year ends in the calendar, just like the calendar. So December 31. And so we have to analyze like 12 months from that date if the entity still has the ability to continue as a going concern. All right. So to continue, we have accrual basis of accounting. In accrual basis of accounting, we assume again that the entity will have to recognize income when it is earned and recognize expense when it is incurred. When you say recognize income when it is earned, it is when the goods are, of course, delivered to the customers or consumers, and it is when the management control has been relinquished or transferred to the various customers, for example, or customers. Then income is earned in that case, regardless of when it is collected, while expense is incurred. So as soon as, for example, electricity has been used or the resources have been consumed, despite the fact that it was not paid yet, then we are going to assume that the expenses are incurred. So simply put, accrual basis of accounting states that income is earned regardless of when collected, while expense is incurred regardless of when paid. So that's number 3. Next, for materiality and aggregation, so we are going to combine items that are of similar nature, and different nature of items should be presented separately, but they can be combined as like the other assets, for example. Number 5 is offsetting. In offsetting, this simply states that we cannot present accounting elements net of each other. So meaning we cannot offset accounting elements unless it is required or permitted by a PFRSS or a Philippine Financial Reporting Standard. So what I mean is that, example, in the same transaction, there is asset, equipment acquired, and there is liability that is for payment. So we cannot like net the two values of equipment and the liability. So that's not allowed by PFAS1 even, so Philippine Accounting Standards even, the more with the PFRSS. However, there are some situations wherein offsetting would be allowed. So example would be, let's say, for a certain sale transaction, there is transaction cost, and then the transaction cost, meaning the cost needed to complete the sale, may be netted to similar sale of items. So there are, let's say, a lot of sale transactions. The netting or the combination of. However, we cannot say that just because we presented accumulated depreciation as a deduction of property, plant, and equipment, and the allowance of doubtful accounts as a deduction of accounts receivable, that they are cases now of offsetting. So they are just means of presenting the items. In fact, they are still separate account titles. The latter, like the accumulated depreciation, is actually a contra asset account, because if you say contra, it is a minus, and then it's contra asset, so a minus to an asset, that's a minus to the PPE. They are still separate account titles. It's just that to present them on the balance sheet, now known as statement of financial position, then that is how we present, so that we will get the book value or carrying value. So more of that will be discussed anyway or later on in other accounting subjects. So that is for offsetting. Next, frequency of reporting. The minimum is at least annually, as said a lot of times. That's the requirement of IAS 1. However, we can also prepare financial statements even for less than a year. So we said that we call these as interim periods as opposed to annual period. And then the financial statements are called interim financial statements. So this is also a separate discussion that we will have under conceptual framework and accounting standards. And then, so the interim accounting periods, or simply interim periods, are actually lesser than 1 year. So this could be monthly or in a month, or quarterly every 3 months, or semi-annual or semestral, good for 6 months. And then the reports could also be prepared when there is, for example, normal operating cycle, actually, or 12 months, whichever is longer. So the point is that the normal operating cycle could also be used as a basis. However, because normal operating cycle is way, way less than even monthly, so that's why normally if we would like to be shorter, then the shorter or the shortest accounting period possible would be monthly. In fact, there is like an operating cycle of 1 week. So we cannot prepare also weekly financial statements, because that's going to be costly for the company in the long run. So it does not make sense anymore, like complete set of financial statements. If ever we prepare financial statements, we have to disclose the period covered, the reason for using a longer or shorter period, especially if, for example, there's a change in the end of the reporting period and the financial statements are longer or shorter than 1 year, and that the fact that the amounts presented in the financial statements are not entirely comparable, in the sense that we cannot compare apples and oranges, as they say. So we cannot compare like a month with a quarter or a semester with a year. That's not making sense anymore. So we have to disclose that fact anyway. Comparative information is when we compare at least two items, could be the performances and the financial position, cash flows, changes in equity of 1 year over the other. So the simplest way of saying this is that to compare, we need at least two items. So we have to prepare or present comparative information in respect of the preceding period for all amounts reported in the current period's financial statement. So to wit, the complete set of financial statements, statement of financial position, statement of comprehensive income, statement of cash flows, statement of changes in equity, the notes even, and additional, we can prepare, of course, the comparative or shall. The word is shall, so meaning it is a requirement. For consistency, meaning we are going to apply a concept or principle all throughout the periods for as long as they're applicable. Because we have also discussed anyway that it doesn't mean that we will be violating consistency now just because we are changing for the better. It is also okay to change for the better, most especially if that would result to more meaningful, useful, relevant, and faithfully represented information. So an entity shall retain the presentation and classification of items in the financial statements from one period to the next, unless it is apparent that another way, of course, would again result to those things as said, significant change, and a PFRS requires change in presentation. Also, when really a PFRS would necessitate that we have to change for the new version of standard. So we call this sometimes the transitional provision. So we have to change for us to be compliant with the revisions of the standards. Next, for that, the additional statement of financial position is presented at the beginning of the preceding period when an entity. So preceding period would be, for example, if this is the year like 2019, 2020 is not yet complete. So let's have 2019, and then let's say there is an additional statement of financial position presented. So it should be at the beginning of the preceding period, which is 2018. So that's going to be January 1, 2018. Applies an accounting policy retrospectively. So we will know under IAS 8 that an accounting policy, meaning a framework, rule, convention that is used by a certain business in accounting matters, or let's say accounting recognition, measurement, presentation, and disclosure items, then we are going to consider retrospective application or restatement, meaning as if they have been there at the very beginning. So we are going to do that. Retrospective restatement is on the second, so as if the amounts are there from the very beginning also. So from the time that the impact has been determined. So let's say there is 2018 error determined, and then that is coming from 2015. So as if that amount, of course, the correct one is coming from 2015. That's the impact of retrospective. So we have to go back to the past from the word retro, meaning past, and or from the prefix rather. Number three, reclassifies items in its financial statement. So there are some items there that are reclassified. So there is reclassification of certain items. And the effect of the event to the statement of financial position as at the beginning of the preceding period is material. So what is material again is a matter of qualitative and quantitative. So it's a matter of the, let's say, quality as well as the size of the items or the amounts. So this has also to be considered because for all we know, we are looking into the impact of errors, but then they're immaterial. So cost benefit principle must be applied along the way such that the benefits must exceed the cost. Then statement of financial position, of course, will show to us several items for us to say financial position. So there is a source that this would show financial flexibility. This would also show liquidity, solvency, and that is for our sources of financing. So those items would also be shown, or source of financing is known as financial structure. So these are the four items that we can see on the statement of financial position. So what can be the means? So it can be either classified or unclassified. If you say classified, then clearly we have to show current assets and non-current assets and liabilities. So to determine if it is current under conceptual framework. So it can be expected as an asset. It can be expected to be used, utilized, to be realized within 1 year or less. So within the normal operating cycle, for example, if it is longer than 1 year. For non-current assets, of course, more than 1 year or the normal operating cycle, whichever is longer. The liabilities will be current if they are expected to be settled or paid within 1 year or less. Non-current if it is more. So these are the classified items. In terms of presenting statement of financial position also, so it is not required actually by the standard to present current ahead of non-current assets and liabilities. It's just that in the Philippines, we are used to, it is a practice by practitioners to present current ahead of the non-current. But in UK or Europe, they present non-current ahead of current. So it depends upon the situation. Second is unclassified based on liquidity. So no distinction of all current and non-current. They are mixed together and they're arranged based on liquidity. Liquidity is the ability of the entity to pay short-term obligations or to use items to pay for assets, though to pay obligations. So that's how we are going to arrange them like all together. But for classified, so this is going to be tricky because we have to really classify them into current and non-current aside from being grouped under aggregation concept for similar items. So that is statement of financial position. Now I mentioned about liquidity. Okay, that's done. Ability to pay under short-term time or period. But if it is long-term, that's going to be solvency. If we talk about financial structure, so that is like the sources of financing, meaning the assets of the company, what percent that comes from the debt, meaning from obligations of the entity, financial obligations, of course, or from issuance of equity instruments in the form of shares, for example. So coming from investors, like what percent. And finally, for capacity for adaptation or financial flexibility refers to how the entity can fastly change or adapt to certain situations or case. Next, current assets, as said, they are current when, of course, they're expected again to be used, utilized, consumed, sold, realized. If they're not restricted for long term, so they're expected to be within 12 months or less. All right, so that's the definition or definitions. On the other hand, for the non-current assets, simply they're going to be defined as the remaining. So it's called a residual definition. These are the definitions of assets. Those items that do not qualify under current assets are known or are termed as non-current assets. So that's how the standard simply define non-current assets. So the point is that we have to know current. Otherwise, it will be difficult for us to really classify the items that are non-current because we just have two classifications, either current or non-current. First one is clear to realize, so meaning this is on the inventories that we sell. Second is for the purpose of trading, so buy and sell, for example, inventories. Three is expected to realize the asset within 12 months or less, or a cash or a cash equivalent that is not restricted from being exchanged or used to settle a liability for at least 12 months. So meaning the asset can be used for 12 months or less, like that cash or cash equivalent. While the current liabilities are current if again they are expected to be settled, to be whole, due to be settled within 1 year or less, or within the normal operating cycle, even if that is longer than 1 year. So normal operating cycle, again, as a repetition from the conceptual framework, is that it is the time it takes for a company to use cash to buy inventories, to convert the inventories to products, if this is manufacturing, or simply buy finished products if this is merchandising, and to convert them into cash. If it will touch receivables, meaning sold on account, so go back to cash. That's a normal operating cycle. So how long would that be? Some would be very, very short, like as what I've said, could be 1 week, or it could be longer than 1 year. So it's okay to present normally or as a normal operating cycle for more than 1 year. This is the standard though, but in practice, normally that's going to be due annually. Like SEC or Securities and Exchange Commission would be requiring 1 year or year-end financial statements as a minimum. For this one, this is interesting. The entity does not have an unconditional right. This is double negative. So the entity has a conditional right to defer settlement of the liability. So meaning there's an option to extend the date for at least 12 months for the due date. However, it is conditional, meaning there is something that is to be taken into account, meaning an additional burden on the part of the entity. In that case, that's going to be current then. Because for sure, the entity would not do that then because of the burden. So better classify it as current. Then we have here currently maturing long-term liabilities. Normally, long-term liabilities that are to be due within 1 year or less, or normal operating cycle, that is more than 1 year, but that's the normal. But again, in practice, as what I've repeated, it's going to be like 12 months as the basis for the due. All right. So that's why in that case, if they will be due within 1 year or less, they become current. However, there are some exceptions to the rule. So for example, if there is a refinancing agreement, meaning there is agreement for the entity to roll over the obligations to another 12 months or at least 12 months. So meaning can create another loan, or it's like the previous loan is changed into a new one with additional 12 months minimum. So in that case, if the refinancing is done on or before the balance sheet date, so the end of the reporting period, so it is still non-current. However, if that is done after the balance sheet date, but before the financial statements are authorized for issuance, so we will mention this in IAS 10 events after the reporting period. So in this case, after the balance sheet date, because it is like this in real life, in practice, it's not like this is end of the reporting period, December 31, all the financial statements will be completed. No, it's going to take months. So normally there would be some extended period, but it should be prior to the deadline set by BIR because the financial statements will have to be audited first or anyway. So in that case, if that is beyond the balance sheet date, but before the financial statements are authorized for issuance, it is a non-current liability if the entity expects and has the discretion to refinance it on a long-term basis under an existing loan facility. So if the entity has the option or discretion to do it. But again, if there is an additional consideration or burden on the entity, meaning it becomes conditional, so in that case, the loan becomes current, right? Then what is breach of loan agreement? Breach means a violation of a loan agreement, also known as a covenant. In that case, if we breach an agreement of a loan agreement, it is possible that the liability becomes payable on demand despite the fact it is still a long-term liability. So take note that a breach of a loan agreement that would result or that would make it a current liability is not applicable to all types of loans, meaning this has to be a provision of a certain loan or an agreement or a covenant of that loan. And this is the general rule. Exception is that it is presented still as non-current liability if the lender, meaning the person who or the entity or the business that lends or that extends financial consideration to another entity or that allows another entity to borrow him or to him or from him or her or it, if it is an entity, if the lender provides the entity on or before the balance sheet date a grace period. So this is the period in which the entity is still not liable yet, ending at least 12 months after the balance sheet date to rectify a breach of loan covenant. So take note that it is the lender that provides the entity. So it's not yet, or it's not like something that the borrower can have this particular right to do it. So clearly it is the lender that has this particular consideration. All right. So this is part one of PAS1 presentation of financial statements, and see you around for the second part or half. Thank you very much.